war in Ukraine dealt a body blow to the global economy, even as it was reeling from the aftershocks of the pandemic.
We are rightly worried about what comes from there, but I'm more worried about what's going to happen to our exporters.
Inflation is starting to come under control after running rampant for large parts of 2022. India's startup ecosystem got a reality check as the global monetary squeeze hit them hard.
Every quarterly results, I always say it's a balance between growth and profitability.
Earlier it was just growth, at the compromise of profitability. Now we're trying to do the and.
We've discovered where the revenue, profitability and line items are. We pruned many line items. We focused on what matters.
Turning in a profit became the all-consuming mantra. But amid all this, the economy has shown signs of resilience.
The world needs resilience. So India plus, when I say that, I mean India takes the lead and builds this ecosystem so that we become an alternate, resilient supply chain for the world.
Will the finance minister chart out a roadmap to turn a resilient economy into a resurgent economy?
Yes, ups and downs. Yes, today was a bad day, but I will see tomorrow better.
For 23 years, this has been your budget destination. The CNBC TV 18 budget coverage for 2023 starts right now.
Hello and welcome to CNBC TV 18, your one and only budget headquarters. In the next 3 hours, Finance Minister Nirmala Sitharaman will be delivering her fifth budget, which will test the government's resolve to stay fiscally prudent. It's a tightrope walk between fiscal prudence and growth, and it's the last budget before the general elections. I'm Sonia Shenoy. With me, I have Lata Venkatesh, Prashant Nair, and through the course of the next many hours, we will have the best and brightest market voices to tell us how to approach trade.
Well, hi all of you. The big day is here. This is also the last budget before the 2024 polls, and it comes amid rising interest rates globally and in India and slowing global growth. Market will now watch the FM and how she juggles fiscal prudence with populist policies and, of course, capital expansion. The India Inc.'s balance sheets are now showing optimism, but what's lacking is, that growth booster. The big question is, can the finance minister provide a thrust to growth without upsetting fiscal balance?
That's a tightrope walk, right? Good morning, guys. The finance minister, Nirmala Sitharaman, may tweak income tax slabs, which is a key ask to provide relief to the middle class and increase spends on the poor.
Okay, so lots expected. Let me now welcome our editors first to lay down the complete agenda for you. Shireen will lay out the political landscape. Lata, as always, has the big budget numbers for us. Anuj will be there with the market expectations this time around. Prashant will talk about the all-important tax angle that you need to track, while I'll tell you about the key stocks that you need to watch out for as we kickstart trade. First to you, Shireen, on all the buzz from North Block.
In a few hours from now, Finance Minister Nirmala Sitharaman will rise to present the last full budget of this government. Is she going to bat and go for a 6? That is the big question. Now, if you take a cue from what the economic survey presented just the last 24 hours said, the recovery is complete. It is now time for resurgence, and that has been our thematic here on CNBC TV 18, from resilience to resurgence. Will the union budget pave the way for further growth acceleration? 6.5% is what the economic survey is projecting for FY24, nominal growth of 11%, and that is the expectation that the budget is expected to take forward as well. Prime Minister Modi, outside of Parliament, said that this is going to be a budget the world is going to be watching closely for hope and optimism. So is this going to be an India plus budget? Remember, N. Chandrasekharan, speaking to me in Davos, had said, forget about China plus one. India needs to do whatever it can to try and draw in investments, both domestic and global. Will this budget further take that cause forward? Again, the economic survey hints at the fact that India has emerged as a credible destination for diversification of capital. Could we see more PLI schemes? Could there be more customs duties tweaks? Could there be more business simplification? Those are some of the thoughts that have been put on the table. Will this finally be the budget that bats for the middle class? There has been a lot of speculation that there will be relief this time around. Will there be changes in tax slabs? Will there be tax sweeteners? Will the finance minister deliver? That really is the big hope this time around, especially because a lot has already been done on the corporate tax front. On the corporate tax front, the expectation is that perhaps there could be changes on capital gains, but no one's holding their breath on that just yet. That is going to be something to watch out for very, very closely. Outside of that, sticking to the fiscal consolidation roadmap, that is very clear and very evident if you pick up on the commentary that's come in, not just from the economic survey, which really lays the roadmap very clear, saying that fiscal prudence and fiscal consolidation is the need of the hour. That, in fact, according to the survey, can be the biggest fiscal stimulus because it will ensure that interest costs stay lower. But even outside of the survey, the commentary has been that now that we have recovered from the shock of the pandemic, it is time for us to stick to the path of fiscal consolidation. And finally, the government, will it focus on growth magnets? There have been several that have been outlined. The Prime Minister's Gati Shakti program, which is big for infrastructure development, more PLI schemes, the national logistics policy, the digital public stack. All of that could provide the accelerants to growth. That is also something that the economic survey highlighted. So, of course, that's what we go into as we look forward to Nirmala Sitharaman presenting Budget 2023 in just a few hours from now. Stay tuned to CNBC TV 18, the action live on your channel.
Thanks for that, Shireen. You know, this time we will watch out for the revised estimates of FY23 as much as we watch for the budget estimates for next year, FY24, because this year both taxes and expenses have been much more than what was budgeted last year. So here goes. The first number to watch out for will be what's the nominal GDP growth the budget assumes. Last year, the budget assumed that GDP would grow by 11.1% to 258 trillion rupees. But it actually grew by 15.4% to 273 trillion rupees. This was, of course, because of inflation. Now, FY24, our poll of economists says government should assume a nominal GDP growth of 10% only, taking the GDP to 302 trillion rupees. Okay, now let's come to revenues. This year, that is FY23, net tax revenues were estimated to have grown by 18% by our poll, although the government had budgeted that it would grow by only 10%. For FY24, our poll says the government should expect tax revenues to grow in the same pace as the nominal GDP. That is, it should grow by 10% to about 24 trillion rupees. Now, to this, let's add the non-tax revenues like divestment and dividends. The total government revenue that our poll says we should expect is around 27 trillion rupees. Let's come to expenditure. Key heads to watch out for will be subsidies and capex. Subsidies were budgeted for FY23 at 3.2 trillion rupees, but because of the Ukraine war and food inflation, subsidies rose to 5.7 trillion rupees. That's according to our poll. But it will be trimmed to around 4 trillion rupees this year as the free food program has become smaller and fertilizer prices are coming down. Now, let's come to capex. Capex was budgeted to grow by 25% in the FY23 budget, last year's budget. For FY24, the government may budget that the capital expenditure should grow by a slower 15% to 8.7 trillion rupees. This number is important. The bigger the number, the happier the market will be. Total expenditure is seen by the polls to rise by only 5% to 44.5 trillion rupees or thereabouts. So expenditure 44.5 trillion rupees, revenue 27 trillion rupees means a fiscal deficit of 17.7 trillion rupees or 5.9% of the GDP. The deficit is by far the most important number. It needs to come down because interest outgo has been absorbing more than 23% of the government's total expenses for the past 3 years. 70% of the fiscal deficit is usually met by market borrowing. Now, bond dealers and bankers say they expect a net borrowing by the government of 11.3 trillion rupees through sale of bonds, a gross borrowing of 15.7, 15.8 trillion rupees. Anything more than 16 trillion is going to scare the bond markets, can send yields surging.
Well, every year I focus on what does the market want from the biggest day of the calendar. But this year I am focusing on what does the market not want first, because that's a very small list. Actually, it's not even a list. It's just one item, which is no tinkering with the capital gains tax. There's some chatter around raising short-term capital gains tax, and there's fear that the short-term capital gains tax will be at par with the marginal rate. Also, on the long-term capital gains tax, the market is okay with the holding period being raised from 1 year to 2 years or 3 years. That's okay. But changing the tax rate or taking it at par with the marginal rate is something which will be seen very negatively. And in fact, that will raise the FII exodus from our markets, which is something that we have seen over the last few days. Now that this list is over, let me come to what does the market want. Well, what the market wants is increased spending on infrastructure. The market wants a reasonable target for disinvestment stroke privatization. The last year target was quite lofty. And the market wants more disposable income in the hand of middle class, because that would mean more consumption and those financing the consumption. Basically, the engines of economic growth. Also, I know it's tough to do, but no populism and stick to fiscal prudence. I know we're heading into big elections, but still, that's something that the market would want. In terms of sectoral view, well, the market's focus has been on defense, on capital goods, and of course, on railways. But again, these sectors have already moved. But let's see if there can be further gains from here. Now, how is the market positioned? That, for me, is more important than anything else. The Nifty is down 2.5% in 7 days before budget. Now, anecdotally, the Nifty rallies over 3% in weeks with such positioning, the weekly move that is, on an average. The Nifty normally falls 0.5% or 0.5% before budget and normally rallies 1.5% post-budget. I mean, some of the numbers will come up for you on the screen, and as you would see, there it is. That's the picture. Normally, you would see when the market falls more, it rallies even bigger. 2016, it fell 3%. It rallied 7%. 2018 was an exception where it fell before the budget and fell after the budget as well. Otherwise, after that, you will see if the pre-positioning is already there, if the market rallies before budget, in that case, the market falls before budget. 2020 was the best example, which is the closest to what we are right now. In 2020, the Nifty fell 3.8% before the budget, but rallied 3.2% after the budget. My sense is with the kind of positioning that we have in the market, with the FII shorts and with the sentiment where it is, the bank Nifty where it is, you do not touch capital gains tax and see the markets fly.
On the tax side, there isn't a whole lot in terms of solid expectations this time around. Just a few things I picked up after conversations with top tax experts. Number one, the government had introduced a new tax regime which went into effect from the 1st of April 2020. The aim was to have a system which is more tax efficient for the taxpayer, simpler but also without too many deductions. Problem has been that it has not been taken up in any meaningful way. Expectations are that this concessional tax regime, the new tax regime, could see some improvements to make it more attractive for the common man. Number two, housing has done very well in terms of recovery over the last year. It is also a major driver of the economy. Could the government offer relief in terms of enhanced deductions for home loans? Remember, borrowing cost, housing loan interest rates have increased sharply over the last 12 to 14 months. Number three, and this is the tricky one for capital markets. Capital gains across asset classes are varied with different thresholds in terms of holding period, which enable one to take advantage of lower long-term capital gains tax rates. Could this structure be rationalized in terms of holding periods, harmonized for various asset classes like debt, equity, immovable property, and so on and so forth? And lastly, apart from some tinkering to enable more local value addition and make in India thrust, not very much is expected on the customs duty front. All in all, it's muted expectations this time around, but we will find out soon enough.
So folks, here's a list of the important stocks that you need to watch out for in this budget. Let's begin with the big infrastructure push. Now, the budget this time is expected to focus on an increase in capex both for roads and railways. There is an expectation of a 10 to 15% hike in road spends, and that is expected to grow to 2.1 trillion rupees. Now, this could bring to the limelight all these names on your screen: L&T, IRB Infra, Ashoka Buildcon, along with smaller names like PNC Infra and KNR Constructions. Now, railways is also a key focus area for the government. In FY23, you had the budgeted spend of 1.37 lakh crores. Now that is expected to rise to 1.8 lakh crores in FY24. The stocks to watch would be names like RVNL, JSPL as well as Siemens. Along with L&T, higher infrastructure spends could mean more orders for companies like ABB and Thermax. But the big focus area for the government undoubtedly in the last few years has been on defence. The capital outlay on defence services was 1.52 lakh crores in FY23. It's expected to rise to 1.8 lakh crores in FY24. A broad government defence push would aid stocks like the ones you can see on your screen, HAL, Bharat Forge and BEL. Now the next sector to watch is power, as the focus shifts to growth in renewables and energy transition. There is clarity that's expected on the incentives for hydrogen mission as well as for coal gasification, and expected beneficiaries could be names like Reliance, NTPC as well as Tata Power. Any incremental incentives or subsidies for electric vehicles could boost names like Tata Motors as well as some of the auto ancillary players. Let's move on and watch for any excise hike on cigarettes in this budget. Now remember, there hasn't been an excise hike in the last 3 years. So if the potential hike is beyond 10%, which is unlikely, but it would be taken quite negatively, especially for names like ITC. Finally, since it is the last and final budget before the general elections, any populist measures to be watched out for in the consumption space. Additional rural schemes similar to the Manrega or the MSP hikes could be expected, which will result in more money in the hands of rural and low-income generators. This would benefit consumption names like HUL, Dabur and Britannia.
Wow, that was exhaustive. Thanks for that, Sonia. Well, just a word on what I said. You can see that I stuck to the 10% nominal GDP growth figure for FY24. The economic survey has pegged nominal GDP at 11%, but our economist CNBC TV18 poll pegged it at 10%. So I went with that. Well, now back to the budget. As always, CNBC TV18 brings the best local and global market watchers, economists, corporate leaders, tax experts, and of course, not block policy makers. So let's tell you what's lined up for you over the next couple of hours. Here goes. Catch the most authoritative analysis of Budget 2023 with the biggest and most influential voices. CNBC TV18 budget editors, former Revenue Secretary Tarun Bajaj, market veterans like Ramdev Agarwal and Ashok Wadhwa, as also Dinesh Kanabar and Sajid Chinoy will be joining to give their take on what Finance Minister Nirmala Sitharaman has to offer. Stock market has been subdued in the run-up to the union budget, and our market masters Ramesh Damani, Madhusudan Kela, Mahesh Nandurkar, Nilesh Shah of Kotak and S. Naren of ICICI Pru will tell us their key expectations from the street. The budget is likely to set the tone for the markets amid inflation and possible global recession fears. Shankar Sharma, Prashant Khemka, Sunil Singhania, Sanjay Dutt, Sandeep Bhatia will also be joining to tell us the way forward. Dharmesh Mehta, Devina Mehra and Saurabh Mukherjee join us to tell us more about their investment strategy. And finally, Gautam Trivedi, Rahul Arora and Nilesh Shah of Envision will be joining in to talk to us about market trends and what lies ahead. Foreign investors have been big sellers in India in the run-up to the budget, selling over 36,000 crores of shares in January itself. Some of the biggest India investors will talk to us about their take on the market. The key ask from Finance Minister Nirmala Sitharaman is to balance fiscal needs with structural reforms to support medium-term growth. And some of India's leading economists will map the macros for us. Industry's creme de la creme will tell us how balance sheets are looking and what their wish list is from the Finance Minister. From seeking lower individual taxes and higher capex for infrastructure to creating better employment opportunities, these are some of the key asks from Nirmala Sitharaman. Tax is the other big factor to watch in the annual fiscal budget. For the salaried class and for corporates in particular, we will be joined by top tax experts with their angle on the taxes. And finally, voices from North Block. Civil Aviation Minister Jyotiraditya Scindia, Niti Ayog's CEO Parameshwaran Iyer, DEA Secretary, Finance Secretary and the revenue secretaries and the other architects of the budget will join in to talk to us about the economic impact of the finance minister's announcements. Okay, and the first of the guests are already with us. Sonal Verma, the Managing Director and Chief Economist, India and Asia ex-Japan at Nomura Financial Advisory and Securities, and Jahangir Aziz, Head Emerging Market Economics, Research and Commodities at JPMorgan. Sonal and Jahangir, thank you very much for joining us. Jahangir, let me come to you. You have stayed up for us, so thank you for that. What should be the big numbers that you will watch out for? Which is, 1, 2, 3, that they should get it right?
You've already started with one, right? You started with the nominal GDP, right? And that is key to figuring out what is going to be the basis on which we will make a judgment on the tax numbers that they will have. You talked about 10. We probably have a tad lower, around 9. So that's clearly the big number that we were looking for. And obviously, the size of the fiscal deficit reduction. We are looking at a 0.5 percentage point to 5.9%. And that is going to be key in figuring out whether or not India will be able to maintain macroeconomic stability throughout, the fiscal year 24, because that essentially is going to drive what is going to happen to India's current account deficit. And clearly, current account deficit, even the CEA talked about it in the economic survey, is one of the key concerns as we go through in fiscal year 24. No,
Jahangir, see, whether we take a 9% or 11% would mean whether you're taking the GDP at 303 trillion or at 300 trillion. So when it comes to 5.8% of the fiscal deficit or 5.9% of the GDP, the difference will be 17.5 trillion or 17.7 trillion. Is it such a big deal?
No, that's not the big deal. The big deal is that on the basis of that, how much is the gross tax revenues that the government actually puts into the budget. Remember, over the last 2 years, this team in North Block has systematically underestimated tax collection, and that has clearly been one of the reasons why India has managed to over-consolidate over the last 2 years. But they had been supported by a very strong nominal GDP growth this year in particular. But if you start with a base of around 9 or 10%, right, you don't really have that much leeway anymore in order for you to understate the tax collection and then over-deliver towards the end of the year. Right. That's been the strategy, and so that strategy now is going to get tested.
Okay, we won't have to wait too long to find out. Sonal Verma is also joining in. Sonal, thanks for waiting by. I think the big engine of growth is capex and the amount that the government would invest in terms of infrastructure. The expectation, of course, is that there would be a 15% hike this time around. But what's your own best guess? And do you think the government can cough up more in terms of capex this time?
Yeah, hi, morning. So, our assumption is the government will continue on the path of pushing public capex. While the economic survey talked about incipient signs of private capex picking up, our own view is, given the global slowdown and the broader uncertainty, it's quite unlikely that we will see a sustained turn in private capex cycle in the next 1 year. So I think it's quite important, therefore, for public capex to continue to be front-loaded, else the gap on growth could be a lot more than what the economic survey is currently estimating. Net, we think capex will continue to be pushed. On aggregate, we're looking at capital expenditure being stepped up by about 20% year over year. So from about 7.4 trillion INR in FY23 to about 9 trillion INR in FY24. Now, the second question in terms of whether the government will be able to actually walk these numbers, I think that's going to be a bit more challenging. As Jahangir was mentioning, in the last couple of years, the assumptions around tax revenues have been more conservative. This time around, it looks like it could actually be on the other side. If the underlying assumption is real growth of 6.5% and nominal growth of 11%, we think the risk is clearly towards disappointment. Our own assumptions for real growth is around 5.1 and nominal GDP growth of 8.5 to 9%. So we could end up seeing more rosy assumptions around nominal growth and revenues this time around. which could mean a bigger trade-off on how much capex the government can do this year.
Right.
You know, many people told us under 6% real GDP. But Sonal's was the lowest at 5.1.
Yeah.
So when I took the average, I actually took out the outlier. Even then, I got an average of 5.9.
But so much of it is dependent on what happens to the globe, right? And I want to just, Sonal and Jahangir, good morning. Jahangir, and we've discussed this before as well. What happens to the US, what happens to the globe will have an outsized impact on, I mean, what we're able to do here. But that is also such a fast-moving picture, or maybe it's not fast-moving. We're reporting on it daily, so it looks fast-moving. What is your sense now? Are things looking a little better, especially in the US? You know, we have data overnight which shows wage inflation is starting to come under control. It's basically looking a bit of a kind of risk-on environment. Financial conditions are looking a little easier. And of course, we go into the Fed later today. But from a slightly next couple of months perspective, are you a little more sanguine about the US and growth there? Your sense?
Yeah, I mean, I think what has happened over the last 2 months has been quite dramatic. I think the fears that people had that, you know, US would fall into recession in the first half of 23, that's quite faded away. And even if there are recession risks down in the fourth quarter and the first of 23 and the first quarter of 24, these are much more modest numbers people are talking about. So I think broadly speaking, this scenario of soft landing has probably got higher probability over the last 2 months than before. But I think more than that, I would say that, you know, the European recession now has been pushed back because natural gas prices have come down. And I think the biggest change has been this massive reopening that's happened in China, which is, you know, everywhere, everything all at once reopening, which was not in anyone's radar. It was supposed to be a nice calibrated reopening. So I think the combination of all three of them and the fact that you now have a dollar that has actually peaked and is weakening, I think provides a significant amount of headwind to emerging market assets. But I would sort of warn that looking at that and saying that that is going to continue for the rest of the year would be something that one shouldn't make. And I think as far as India is concerned, I mean, I find that, you know, I agree with, you know, Sonal, you know, we have also in the 5-handle growth in FY24. It is extremely hard to look at growth going beyond that. I mean, just think about the arithmetic. Don't forget about the economics of it. This government or the CSO has 7% annual growth rate for FY23. We had first quarter of 13.5, second quarter 6.3, which means that the government itself is telling you that in the second half of this fiscal year, growth is going to be around 4.5.
Yeah.
So the run rate, and this is not I mean, this is just tyranny of arithmetic. It has nothing to do with economics, right? So if you're going to talk about 6.5–7% growth rate in FY24, you need India's growth rate to jump from a run rate of about 4–4.5% to 6.5–7% for next four straight quarters.
Jahangir, that's also the tyranny of arithmetic. That's also the tyranny of arithmetic.
That is also the
you know, this 4.5% is because last year, same time, there was a tremendous growth in India because we were coming out of the Delta and there was a lot of consumption. So this 4.5 is a base effect as well.
Absolutely, but if you're going to tell me that growth is going to be 7% and it's going to jump from the run rate of 4%, then you really need some drivers around you. If the global economy was...
Let's be fair to them. They've not said 7. They've not said 7. They said everyone is saying 6.
6.5.
We are saying 6.5.
6.5. 6 is a 200 basis points increase in the growth rate. I mean,
it's 150 basis. We are at 4.5. Okay, let me get Sonal in on this. Exactly the points that Prashant asked Jahangir. The world is looking slightly clement now. You know, people are talking more about a soft landing than a hard landing, and there is the China reopening. So, Sonal, you know, can we do better in terms of growth? Our global impulse is not going to be that big a headwind.
Other things do look better compared to what one had expected a couple of months back, but I would say we are not out of the woods yet. The monetary policy cycles work with long lags, and we've seen sort of synchronized aggressive tightening only in the last 9 months or so. So the full impact of that on labor markets and consumption, I think, is yet to be seen globally. So in our baseline, we are still expecting a recession both in US and Europe, although less than what we had anticipated a couple of months back. Now, China reopening, of course, has been faster than expected. I think the question is to what extent there will be spillovers from there. Now, the services side of consumption within China, outbound tourism from China is definitely going to pick up. But the extent of pent-up demand because of household savings, the extent of policy stimulus that will truly turn around the property market cycle, given unemployment, particularly youth unemployment, is quite high, does suggest that the spillover on non-services consumption and on the property market could be slightly lesser than what one is expecting. So, I mean, we have raised our 2023 growth projection for China to about 5.3 from 4.8, but also lowered 2024 to around 4.5%. So it's better, but not great in terms of sort of China bailing out the world. Now, coming back to India, Lata, I think, I agree on the 4% being because of high base from last year. But if you look at the July-September quarter GDP and even the quarter before that, on a quarter-on-quarter annualized basis, the run rate is actually closer to 5.5%. So to assume that for the full year FY24, we'll have a growth of 6.5%, we are saying that not only will these spillovers from global slowdown be less, there's going to be an acceleration in the private capex cycle, acceleration in public capex cycle, acceleration in private consumption side, which we have not seen any of those effects. We have just seen the export slowdown. Historically, the export slowdown spills into private investment slowing down. That is yet to actually materialize. And even in India, the effective rates have gone from 3.35 to 6.25 now. Yeah. The impact of that is yet to be seen. So I do not see how growth can be anything in a six handle.
All right, we take your point. That's extremely cogently argued. So let's see what they assume. Let's see whether they assume an 11-12% tax growth based on an 11% GDP. Then perhaps there will be some bit of disbelief, at least among the bond dealers. Thank you very much, Jahangir and Sunil, for joining us. We will touch base after we get the real numbers, of course. Well, just a word on now from the economy to the markets. My own sense, Prashant, is that the markets are entering the budget extremely light. We have the ingredients of a rally, I would think. One, because the asks from the budget, according to me, is not very high. Don't do anything wrong for us on short-term capital gains on equities. Even if you increase the term short-term from 1 year to 2 or 3 years, that will be taken. But if you make the rate to marginal rate like debt, there will definitely be negative reaction. I don't see why the government would shoot itself in the leg. And then fiscal deficit, capex are not very big asks in terms of numbers, given the tax buoyancy that we are seeing. Also, if you look at the fall from Jan 24th, the market is sitting very light. And finally, global backdrop is extremely positive. Not just the economy we discussed, but look at the way risk-on assets have gone. And if the Fed played to the market's expectations and actually toned down in some fashion, then I think there are ingredients for rally. But your take?
I mean, Lata, I actually went back and looked at last 15 years of data, and this, is there a seasonality around the budget, which is if the market goes into the budget 2 weeks prior in a very weak fashion, does it set us up for a rally after? And it's actually pretty random. I mean, that's what I found. I found 4 instances in the last 15 years when the market has sold off 3% or more. And then what happens after, sometimes it goes down another 4-5%. Oh. And so, I mean, there is no, you can't latch on to that kind of say, and it's going light. Absolutely, completely agree that it is light and expectations are running low. So that's essentially what I want to quickly put out, a few things, few points on the table. So, budget, of course, is always important. It sometimes turns out to be a bit of a turning point, but expectations are very, very low. The markets are just hoping one thing, as Lata also pointed out, leave the taxes alone. Don't do too much. When you talk about taxes, people worry, well, how can it be positive? It's going to be higher taxes, not lower taxes. And I think that's why people are of the view that, well, if that doesn't get changed, then we are in an okay place. The Nifty yesterday, just a couple of levels which are also important to note, because, I mean, we've had such large moves last few sessions. The Nifty yesterday saw the second day of positive close, and it is in a bit of a recovery mode already as we enter this particular session. In the very immediate term, the Nifty could retrace to, unless, of course, there are some unforeseen sort of announcements in the budget, the Nifty could retrace to 50% and then 61.8% retracement of the fall that we've seen over 4 days. 24th of January to the low of 30th of January. It's just 4 trading sessions, and the 50% and 61.8% retracement are 17,803. That's the first level. And then if that gets taken out, you get to the 61.8%, which is 17,897. So these are 2 levels. On the way down, the recent low of 17,405 should not break. I mean, it should hold. It's not very far away. With large moves, anything is possible, but that's essentially the line in the sand. Global cues are solid, Lata. Yes, overnight we got soft data. NASDAQ is up, S&P is up. And technically, things in the US are looking a little better, right? Prices lead, opinions and data follows. The NASDAQ has completed, as of yesterday, because it's a monthly close as well, a major double bottom. The S&P E-mini futures have ended above their 55-week moving average. So these are good global signs that we are starting the day with. There is the Fed decision today. 25 basis points is given. I don't think anyone is penciling in a 50. And we'll hear from, Jerome Powell in terms of how he lays out what he plans to do. Rates higher for longer, or does he take note of some of the softer data that we've got? If we get the latter, I think it adds to the optimism that maybe the market can climb a little higher from here, at least in the near term. Sonia.
Okay, in fact, we have a market voice joining us now. Arvind Sanger, Managing Partner, Geosphere Capital, is with us. Arvind, very interesting times because, this is the last budget before the big election. So there will definitely be some populist measures that the government could look at. And then again, the global backdrop is not too bad as we head into the budget today. Your own expectations from a market standpoint, do you think the worst of the sell-off is now behind us?
Well, first of all, let's be clear. The sell-off was not caused by budget concerns. So budget will be important, but there are other issues that, that will drive the market in addition to the budget. But in terms of the budget itself, I think that the budget, my view on budgets is do no harm is the most important mantra for any budget, right? So if they can follow that mantra that they will not do any harm in terms of hurting investor sentiment or, you were talking about capital gains tax or anything else that would be negative. Obviously, the government has limited fiscal headway to hand out goodies in terms of things that might excite, the market in terms of, economic tax breaks or anything like that. But I'm hopeful that, the roadmap that the government has shown of fiscal responsibility continues. The question is, what kind of trajectory do they see towards their long-term, targets of fiscal deficit. And it'll be interesting to see how they get there, because the reality is that so far, one of the disappointments over the years for Indian budgets has been almost always too optimistic on divestments and almost always not able to deliver on those numbers. So, it'll be interesting to see the roadmap, and that'll be useful not just for the one-day rally or no rally, but for the coming days and weeks.
Okay, actually, they have somewhat got over this large divestment numbers. Last year itself, last budget was a bit modest. But Arvind, if we can zoom out of the budget itself, the Indian markets have clearly underperformed global markets, both Asian and US markets, in the month of January. How serious is the Adani episode from an FPI point of view? If the budget is good and the economy seems to be growing, as the economic survey is pointing out, will they just come back and bite?
I think so. I think at the end of the day, the growth is there. The economy is going to do fine, and investors will come back. I think the one thing that it does raise is, the credibility of Indian institutions. And I'm not talking about the Adani Group. They have their own ways to answer that. But Indian institutions have to be seen. Indian regulators have to be seen to dealing with this fairly for India to be treated as what it usually is, which is a high-class emerging markets where, people feel like corporate governance is given, fair hearing and fair assessment. And to the extent that that comes out of this whole episode, that'll help the market regain. Because remember, India was selling off before the Adani episode on a relative basis. China reopening, and I think we talked about this a few weeks ago. China reopening is the trade that is the most important trade. India has kind of, suffered this year what it benefited from last year of China's lockdown. So that's a bigger trade. But from the sideshow of the whole Adani episode, the important thing is, there are a lot of good Indian companies. There's good Indian growth. Just that the regulators and everybody else should be seen not to, be using a brush to brush this under the rug, but to just give a fair assessment of what is being asked of. But other than that, I think the Indian growth story and the Indian corporate quality is good enough that this episode will not interrupt. And I think the budget, as long as it again does no harm, should continue to help the market recover to a more reasonable level. But India will, frankly, continue to underperform China. And the one risk for India, let me put the risk, and the one risk for the US and the one risk for the Fed is, I believe, China's rapid reopening is going to be inflationary. And people who dream otherwise are mistaken. Oil prices are going higher, commodity prices are going higher. That'll have some inflationary impact. And that is the one thing that could upset the apple cart for global markets.
The China stock index is up 57% from the October lows, and it's now trading at 18 times earnings, which is above its own historical average. So it's no longer 11, 12 times. So it's not like at some point, that also will start to reverse, right? I mean, that market itself has done so much, maybe more to go, as Arvind said. Arvind, the US particularly, because that's the most important trendsetter economy-wise, market-wise, is that looking better? The price action is very encouraging. Equity indices, the dollar, what's happening to yields, your sense?
Well, look, bear market rallies always look good. I'm of the opinion that the bear market is not over.
Okay.
You always feel very good about bear market rallies. My view is that the Fed is not going to be able to deliver to the market, what it hopes in the medium term. Yes, it'll do 25 basis points almost certainly in this next decision. But beyond that, is it going to be able to ease off? If inflation proves to be stubbornly high, above 3%, when the Fed target is 2.5%, that could mean a little more pain for the market. So I don't think that it's going to be as straightforward.
Okay, budget or no budget, right? I mean, this market has been under pressure for a while. Let's not fool ourselves. I mean, in the month of January alone, there's been, over 40,000 crores of selling from FIIs. Is there anything from a foreign investor standpoint that can change in this budget? I know a lot has been done off budget as well, whether you talk about, infrastructure development in sectors like defense, renewable energy, power, etc. So a lot of the good work has already been done. But from a foreign investor standpoint, in this budget, anything that you're looking forward to?
Well, I think we're looking for signs that the Indian government is going to continue to invest in things that can help improve the infrastructure. So CapEx is important. I don't want to see deficit reduction on the back of CapEx cuts. So Indian government continuing to do infrastructure spending is important. But Indian government announcing something bold, like, they've been talking about Concord, maybe they're throwing Hindustan Zinc, some specific plans for more aggressive, getting out of the economic parts of the economy that the government doesn't need to be in. More signs of that. Anything more on the infrastructure front, anything interesting on that front would be important. But I think other than that, the most important thing is to have a credible fiscal path towards the government not crowding out private sector and providing the support for private sector to feel confident about raising capex, and interest rates going to be not crowded out again by government borrowing. So I think those are the most important things. I'm not looking for whether it's PLI stream or anything else, any big bang announcements. Maybe I'm missing it, but I'm not looking for anything that's going to dramatically change the equation.
Okay, do no harm, as you said, right? As they say, no news is good news. All right, Arvind, thanks a lot for stopping by and giving us a quick primer on what to expect from Budget Day. Let's take a break on that note on CNBC TV 18. But here's a quick reminder that we will have the very best policy makers, market masters and tax experts as budget editors to take us through all the major announcements that come through from the budget today. Stay tuned for the in-depth analysis and expert opinion all through the day, only on CNBC TV 18.
Good morning if you're just joining us. And of course, this is the budget special this morning. We are awaiting Nirmala Sitharaman presenting her fifth union budget. Still about, 3 hours to go for that. There's news coming in on State Bank of India. They've hiked their one-year lending rate by 10 basis points to 8.4%. This is, of course, something which we've seen other lenders also do. Lending rates, how high will interest rates be, for how long? This is something which, of course, the economic survey pointed to as well. Important component of the macros that we discuss. We're getting you the top voices. James R. Sullivan is now joining us. He's Managing Director, Asia Pacific Equity Research at JPMorgan. Rana Gupta is also joining us, Senior Portfolio Manager, India Equity Specialist at Manulife Investment Management. Gentlemen, great to have both of you here. Thank you very much for your time. James, if I can start with you, what are your key headline expectations from budget today?
So at a high level, we see a series of offsets. On the one hand, we do expect that a significant reduction in food, fuel, and fertilizer expenses significantly gives scope to continue to push the government's capex agenda. Just as an example, urea, which is a key ingredient in fertilizer, pricing is down over 50% since September. So that does give incremental room to spend. The flip side of that, obviously, is the intention to reduce the overall deficit level that's contained within the budget. So we do see these series of offsets. At base, the biggest and most important conclusion from equity markets that we do expect is a continuance of the government's capex push, which is positive for industrial stocks in India.
Right. James, thanks for joining in. We have Rana Gupta as well of Manulife with us. Rana, the thing is that we're heading into the budget with a very chaotic global environment. There's perhaps a recession coming. There's a large amount of FI selling in the Indian markets as well. Do you think there's a post-budget sell-off that we're looking at in both global as well as in the Indian markets?
Hi, good morning. That's always hard to say, but I do think the sell-off that you referred to in the first month of the year was more to do with China reopening. And Indian markets have outperformed over the last 1-2 years. And with China reopening, there were always some reallocation of asset to asset that would have happened, and that has happened. After the budget, I think we will be back to the global trends, and the earnings season, the way it pans out in India, we'll be back to that. But I do have to say that in the last 1 month's correction, the valuations have become a bit more reasonable in India, and China has also rallied. So last 3 months, it has outperformed quite a bit. So overall, in relative context, I think India's valuation premium has corrected. Earnings season is, I think, more or less all right. So I think overall, some of the underperformance that we have seen in last 1-2 months should actually begin to reverse.
Okay, good morning, Rana. Thanks for joining us. Aside from assuming the budget doesn't do anything good or anything too bad for the markets, do you think India is in buy zone? As you point out, the China plus and India minus theme played out? Or do you think this Adani story is a fresh negative, or is it ignorable?
I think recent events that has happened is that I think beyond the group that got into all this news, beyond that you have seen pretty much correction across Indian banking, industrial names, materials names. Now, of course, that group is very important, but not so much to cause that much of correction in the banks, industrials, and material prices. In fact, those corrections are the reasons why I mentioned that the valuations are now looking attractive, because some of those companies in banks, in materials, industrials, they reported numbers. The numbers are quite good. The only complaint we could have had is that they had run up, they had done very well, valuations were higher. Now that has now gone. So therefore, I think those sectors are looking good, and those sectors make up for very decent part of the index. So therefore, there are quite a bit of opportunities that we see post the recent correction.
Okay. James, what is your own view on how to approach India now? There was a significant degree of outperformance that we saw last year, but do you think that's something that can continue? Are you a bit cautious now? And where does India feature on your pecking order?
So at the moment, we're overweight China, Indonesia, and Korea. We are taking a more cautious stance on India for a variety of reasons. As you said, you saw significant market outperformance over the course of last year. The Indian market's given some of that up. We've seen the performance of the Indian market, in particular relative to China, peak in November of 2022. The market has since given up gains back to, let's call it, spring of last year. So it has given up some of that outperformance. However, over the longer term, there still is significant downside relative to where the market used to trade, in particular relative to China. So it's really all eyes on the relative growth rates of China and India. China is an interesting story this year. From a JPMorgan perspective, we do believe that China will see good economic growth, but it will be consumption-led. And that has impact on commodity pricing around the region in ways that are mixed across the Indian sectors. One of the Indian subsectors that we are very excited about is the generic healthcare industry. We've seen significant price compression in markets like the United States as we went through the COVID period. Our bottoms-up analysis does indicate that the downside to generic pricing globally is starting to stabilize, which is potentially very positive for the generic subsector in India.
That's interesting. I'll pick up on that later, James, in a bit. Rana, when you say interest may come back into India after the underperformance we've seen, where will that interest show up in the most meaningful way to begin with? Is it going to be banks, which is a consensus overweight, but which is also the one sector which suffered the most in the last 3-4 days of market sell-off? What's your sense?
Yes, I think banks will certainly be a candidate because they suffered quite a bit in this correction. And we do think that correction was a bit excessive. So therefore, the banks can be one of those candidates. Also, I think in sectors like materials, particularly cement, there were fears of price competition. But I think recent events would mean that price competition may not be as severe as markets would have thought. So I think, and cement stocks corrected. So I think there's also opportunity in the cement sector. We have been bullish on industrials, and industrial stocks also did not correct that much. We continue to remain bullish on the industrial stocks as well.
Okay, Rana, just stay on. Let me get James on stocks as well. James, tech stocks, I'll come to tech in a bit. What are you advising on banking stocks now?
So banks is a key overweight. There's two concerns that we have there. Number one, it does feel like everyone's overweight Indian banks right now. We feel we were slightly early into the trade, but our measure of investor positioning indicates that it is a relatively consensus holding, particularly for most international investors. The thing we're watching closest right now is evolution on two statistics. Number one, net interest margins, where we do think there's room for positive surprise relative to current street-side forecasts. The more concerning element is as the Indian economy starts to slow as we go into the second half of 2023, we could start to see bad debt provisions starting to spike up higher than expectations, which would clearly be negative for financial stocks. And so that's something that we're watching very closely, particularly as we move into the second half of this year.
So that's an interesting point. Rana, you had mentioned that you like banks as well, but as James was pointing out, anyone and everyone is overweight on banks right now. Would that make you a bit uncomfortable? Do you think it's a bit of a crowded trade? And what is your expectation as we move along through the year?
I do think the banks are, I think many people hold this top banks. So therefore, I think within banking sector, one has to a bit more nuance to get, pick the right stocks. So for us, I think we would say that the larger cap banks, where we are most positive. And if you look at the results carefully, you will see that some of the banks, the larger banks, where the OPEX is coming under control, because the net interest margin will clearly peak in next 1 to 2 quarters. You have to look at banks where there are levers to bring the OPEX under control. Therefore, those banks can deliver EPS growth. But this is one part to it. The last time I was on your channel, I mentioned in the financial space, we also like the life insurance part. So I think that is also one segment where we are positive within financials.
Now, you also mentioned materials. So you would be buying material stocks now?
Materials largely referred to cement, because I think cement stocks suffered correction, and now I think there's an opportunity to look at those stocks again.
Ambuja in particular, Rana, if you can name names?
I won't be able to discuss stock names.
Okay, no problem. James, what is your view on the sort of Adani Group stocks and any potential lingering impact on markets overall, your sense?
We've published significantly on the range of information that's available in the marketplace today and had very significant client interactions off the back of this issue. I think the key thing that we would focus on is the very basic issue of transparency. The more information investors have at their disposal, the better decisions they'll be able to make. And that's positive for equity markets, not only in India, but globally.
Okay, James, appreciate your thoughts. Thanks a lot for joining us on CNBC TV 18. And Rana, before we let you go, anything specifically from the budget in terms of individual sectors that you're looking at? I mean, a lot has been done in infrastructure, defense, renewable energy. There is some talk of tinkering of the tobacco tax as well. What would your key preferences be sectorally?
Actually, there are no sectoral preferences that we have going to, or expectations that we have going to the budget. I think budget, I'll just say two very quick things. The budget, and if you look at not just this budget, look at last 4 or 5 budgets. Budgets have become more of a transparent, credible, and simple exercise, which we absolutely welcome. And the quality of revenue is improving because the tax collections are doing better in spite of tax rates being stable. So that's very welcome. And the quality of expenditure have been improving. Less of revenue expenditure growth, more of capex growth. So we expect the similar trends to continue. This has implication not just today, but longer term for 2 sectors. As the domestic savings grows, it bodes well for the domestic financial sector. And as capex grows and the domestic savings grows, that also bodes well for the private capex, i.e. the industrial sectors in the stock market. But that's just not for today. That's for medium to longer term view.
Okay. All right, Rana, thank you very much for your time. Great speaking with you. James, appreciate you joining in with that perspective as well. Appreciate it. Well, as we slip into a quick break here, here's a quick note that we have a star panel lined up for you immediately after the Finance Minister delivers the budget speech. The panel comprises big voices from the government, top voices from Dalal Street, and the very best tax experts to analyze every important decision announced. That is today. Stay tuned and catch CNBC TV 18 Star Panel for the most in-depth analysis and expert opinion. We'll take that break. On the other side, we will be joined by Rahul Arora of Nirmal Bang Institutional Equities and Devina Mehra of First Global. Saurabh Mukherjee of Marcellus Investment Managers will also join in for some perspective. Post that, technical trading ideas with our experts Sudarshan Sokani and Mitesh Thakur follow.
Big day for the economy, big day for the markets, and we have a grand panel with us now to discuss markets. Rahul Arora, CEO at Nirmal Bang Institutional Equities, Devina Mehra, founder chairperson and MD at First Global, and in a bit Saurabh will also be joining us. Rahul, let me first attend to Devina since she's waiting by for us. Devina, is the budget really going to move the needle much? A lot of people so far have told us that so long as they don't do anything terrible like short-term capital gains on equities going to the marginal rate, we are cool. We don't have too much of expectation. Is that fair?
I think that's fair, and budget should not have too much to do with the markets. I mean, nowhere in the world is budget such a big event, at least as far as the markets are concerned. It is, and as we evolve as an economy, I don't think it should be a huge event for us also. And on capital gain side, what I expect from what finance ministry officials have been saying on your channel also through the year, that maybe there might be some rationalization because on capital gains, different assets have different rates, different holding periods, different indexation benefits. So there might be some rationalization on that. But my expectations on the budget are more on the policy side rather than on the taxation side.
Okay, so we'll come back to that. We have Rahul Arora here in the studio, and he's celebrating his birthday with us today. Rahul, happy birthday.
Thank you.
Big day for the economy, big day for you as well. Are you having high expectations from the budget this time? Or as Devina was saying, it's just a financial statement at the end of the day and not going to move the needle of the market too much?
Well, as long as it gets me a glass of scotch at the end of the day, I'm all right. No, but on a serious note, I think I agree with what Devina has said. I think the only, beyond what has been discussed, I think the only thing would be not too much of a slippage on the fisc I think we're working with about 6.2%, between 6 to 6.2. I think the math credibly adds up there at that point. I think beyond that, I think the one thing I'd want to hear...
You're expecting 6.2?
We are at...
the economists will disown you, but anyway, go ahead.
No, so I think, Lata, you've seen the subsidies that they've had to give for petroleum and fertilizer. So I think even they may actually announce a number around 5.8, 5.9, but I think as the year goes on, you're in a pre-election year. I think towards the back end of the year, there might be a little bit more. I think at 6.2, you're looking at a 7.3% 10-year. I think that should not upset the cart too much. I think it'll fit into the RBI's mathematics.
6.2, I think it'll be more than 7.3. Because it's 7.3 now on expectations of a 5.8 fiscal deficit. If it comes at 6.2, my sense is, even now, it went up to 7.39 yesterday, the 10-year. But anyway, be that as it may, your expectation is that even 6.2, the equity markets will...
I don't think so, Lata. I think, the one thing we also have to keep in mind is that government capex has not been that strong this year, right? In the reported numbers by the Government of India itself, the period of April to November, capex is down about 76%, and at the state level, it's equally bad. I think it's only private sector capex for this period from April to November that's up. So I think as the year goes on and the government has to invest in capital expenditure, obviously that will be another added over and above what they do on the subsidy. So I think somewhere between 6.2 should be the number that we work with, even if they announce something on the lower side. Beyond that, I think it's a little bit of tinkering on income taxes. I think, if there is a lot of talk about, at the higher end of income tax, there's such an anomaly with respect to corporate taxes. And at the bottom end, can you do a little bit more relief that can probably help consumption? But all things considered, I think, this government there's one thing that they've done is they've kind of rendered the budget ineffective because of these PLI schemes. And there are a lot of announcements during the year as well. So I think the more important thing will be what the Fed says tonight and what the RBI says next week. And I think that has the potential to either take the Nifty to 17,000 or back to 18. I think let me summarize it this way. No negative news will be good news today.
Okay, I just want to say the government has done very well on capex, central government. States have fallen way behind. They've barely done 38% of what was allotted. But centers more or less kept, April to November. I didn't see the April to December numbers. April to November, about 68% of full year budget had been spent, which was quite decent. Devina, you said you will worry more about policies. What did you mean by that in the budget?
No, I didn't say I would worry. I said my focus would be more on policies because that is where I think the government's focus should be, which is the long-term issues in the economy. And there are especially three that to me are important: employment, education, and health. Because employment is what worries me, because we all talk of this demographic dividend for India, but really for the demographic dividend to pay off, there are three components. One is, of course, that you have a large proportion of your population in the working age, which is like you have a lot of young people. But the second part is that how many of the young people are employed, and the third part is the productivity part. So we have the first, and we have it only for a limited number of years. As you know, China's population has actually started to decline, and even for India, the people in the working age will start to decline after some years. So you have it for a limited period of time. But if you're not able to employ those people, then you have a problem, because that's also the driver for the economy, because when the people are employed, they obviously consume and so on. So even before the pandemic, we were at a 40-year low in unemployment. Now there has been a little bit of decline in unemployment, but that's mostly come from agriculture, which is really disguised unemployment, because for the economy to grow, people have to move out of agriculture, not into agriculture. If you look at the Narega numbers, yes, if you look at the economic survey, there has been a decline from the previous year of people. But if you go back to 2018 or 19, we are still at a higher level. You know that 80 crore people require free rations. So that all shows that consumption cannot be broad-based. I mean, if you look at all the industry numbers also, the higher-end cars and SUVs selling, two-wheelers still in the doldrums, all that shows that you need to do something for the wider economy. Education particularly took a hit with the pandemic, with children being out of school. So those are the things, and because unless you invest in education and health, the next lot of people are not going to be employable.
Got it. The lower part of the K, basically.
Yeah. All right. That's absolutely correct. Sonia, by the way, this entire question which we're asking, is the budget important or not?
Yeah.
I decided to ask ChatGPT.
What was the answer?
It's a long answer. I don't know if you want to hear the whole of it, but short answer is yes, it is important for, it's anyway.
Did you really need to ask ChatGPT that question?
I ask ChatGPT everything nowadays.
You automated your own redundancy. Don't do that.
You've automated your own work.
Just for fun. Saurabh Mukherjee is with us as well. Saurabh, hi. Good to have you with us here in the studios.
I think a few years from now, you won't need us anymore. ChatGPT.
Although it doesn't have information beyond 2021, I guess that's a matter of time, right? So
right. Maybe in a few years it will, right? The next version of ChatGPT.
How are things looking, Saurabh? I know your view on the budget. I mean, we've had you on budget days. It's a one day and doesn't really change the course one way or the other. But fundamentally, underlying, how are things looking to you?
I think, look, I mean, in the normal course of circumstances, I would have said, as I've said this time as well, that given that we are a free market economy, the importance of the budget gradually diminishes. But I think there comes a juncture every few years in India where blue collar unemployment is in such bad shape that you do expect the budget to do a little bit on that front. So I don't think I've seen people earning 2 lakhs and less in this bad a shape in the last decade or so. And that data comes through every result season. We see the same story. I think real wage growth has been negative for 3 or 4 years now. So given that there's an election around the corner, 15 months away, I presume it is now or never for blue-collar wages and blue-collar employment. That has a significant impact on many of the stocks that we hold. So from that regard, if you ask me, my one-point agenda on the budget today is to see what can the government do to change the narrative around mass employment and rural wages.
There's a point of view that they can postpone that to the fourth quarter of the current year. That, this can be one of those disciplined fiscal deficit budgets, capex oriented. And the vote on account plus the fourth quarter, out of the budget announcements can take care of the political issues. You don't buy that?
I reckon this budget will be a tight budget. I think to give the government credit, paradoxically, they have been fiscally tight-fisted by and large, right? And I doubt, given that tax buoyancy is decent, the economic growth story is all right. I think the economic survey, the CEA is correct. I mean, we are at a healthy state. I think they'll be tight-fisted on the budget. And I think, Latha, that does mean that the whole challenge around mass employment and rural wages, I think, continues. If it doesn't, I'll be very pleasantly surprised. But my going-in expectation is we've basically set a template very similar to, I would say, Thatcher and Reagan. Tight budgets, fiscal conservatism, and then push the free market to do what it can, which is all right for people in our strata of society. But not.
The budget can sort of reallocate, right? Meet the fiscal deficit targets, etc. But use funds from somewhere else, or maybe...
I agree with you, it can. So capex growth has been, government capex has been growing at 30%. If they throttle that off to 15% and switch some of that to social security spends, I would be happy to see that. But I suspect that's not going to happen. I think this government has very clearly laid out its agenda in the last 2 to 3 years. It's actually quite remarkable. I think Nirmala Sitharaman's thinking, the government's thinking on economics has become far clearer in the last 2 to 3 years, which is clear that we will spend on capex. But other than emergency spends for the poor,
or raise taxes, Saurabh?
I doubt, given tax buoyancy is solid, Prashant, going into an election, I think that'll be tough.
No, I'm saying stock market tax.
It's not going to bring in a huge amount. I mean, they might or might not do that, but that's not going to move the needle.
The number was chunky last year, right? 80,000 crores. And markets they've not done well over the last 1 year.
Exactly. So I think that's where the circularity lies. If you have a bull market, you make money on capital gains tax, whether you charge at 10 or 15%, it doesn't matter. But if you hike capital gains tax in what's been a flat stock market, it's sort of very difficult to make money. Remember, they also have to push disinvestment, which makes it hard. If you're hiking CGT and then pushing disinvestment, it's a little contradictory.
Actually, we were talking to Sonal Verma of Nomura a while back, and she said that growth is expected to slow down materially in the second half of the year, not just because of the developed market recession, but also because of the lagged impact of the tight monetary policy. So given that context that we're heading into the budget with, any other growth avenues that you think the government can eke out? Sort of first to you and then Rahul.
So look, I think the one thing wherever I've had a chance, I've encouraged them to do is, I've never seen public sector banks in this sort of shape. This looks to me a golden opportunity to privatize a couple of public sector banks. That's one of the easier privatizations to do in India compared to, say, trying to sell, say, a shipping corporation of India or some other metals and mining PSU. So you've got banking system in the best shape in 10 years, PSU banks, time to press the button. If they could monetize a couple of large PSUs in the next 12 months, that would give them money, do some welfare spending, good for their election prospects and so on.
Okay, what about you, Rahul? Anything else that you're looking at where the government can spur growth?
So I agree with the point Saurabh made. I think, if you track one company, which is V-Mart Retail, they're almost 75% of their stores are in UP, Bihar and Jharkhand. And if you speak to the chairman, he'll tell you volumes are down 30-40% as of December end. So I completely echo the sentiment that, at the bottom of the strata, things are extremely difficult and, you need to do whatever you can. And I think the only way to do that is either you announce more projects and have people working on them and give them wages, or you give them any sort of incentive that you can on taxation. I don't think there's a third way to actually put money. I think, doing a direct benefit transfer or anything like that is just going to make our economy more ineffective. Just on a lighter note from what Saurabh said, I think instead of privatization, because the RBI did not, give that much dividend last year to the government of India at 40,000 crores, they may actually take more dividend out of the PSU banks this time around as opposed to, privatizing them. That's just, I agree with the school of thought, but my sense is probably, if you look at the UP elections as a barometer and the kind of projects that were announced, I think this is going to be a very, very heavy on infrastructure budget. And as a second order beneficiary, whatever it takes to make that infrastructure, which is cement or whatever, could be another avenue. And the third is obviously the people who are going to work these projects and the income that they get. I think the point both Devina and Saurabh made is very important on the bottom of the society, because I think one thing people miss is the way people in urban India and rural India consume is very different. The velocity of consumption in rural India is much higher. Typically when we go to the malls or something and we want to buy, for example, a Colgate, right? We'd probably buy 3-4 tubes. That guy will just buy as much as he needs, which is why you'd find, people like Lever, Britannia, Daawat talking so much about velocity of consumption in rural India. So either you give them jobs or you give them tax breaks. I'm not a proponent of, putting money in the hands directly. It's a very ineffective way to run your economy. But all things said, I think this is going to be an infrastructure-heavy budget, and I think there will be second and third order beneficiaries through cement and consumption down the road.
I just have a question, Lata. Saurabh, if the budget, so if they do something for the bottom of the pyramid, great, as I think all of you are saying. If they don't, as investors, will you respond in terms of
how you buy,
changing your portfolio around, reducing your exposure to that segment of the population? Or are you already doing that?
Yeah, so I think it's a good point. So I think as you might know, we've exited Relaxo, right? So if I took Relaxo's sandals business was actually doing just fine. The chappals business had been absolutely decimated, right? They had made a few missteps, but to be fair to Relaxo, the 80-100 rupees chappal hammering, a big part of it was the fact that rural wage growth has been negative now for 3 years. So if you're selling chappals to low-income people and rural wage growth is negative, even an 80 rupees chappal becomes hard to afford. So we already, in a way, sort of preempted the budget. I wish they did more for the bottom of the pyramid, but I think I agree with everybody. It's more likely to be capex heavy, and I think the NDA has set out its stall on economics very clearly in the last 3 years, that this is more a Thatcher-Reagan type economics.
Devina, you stay out of India and you look at a whole lot of markets. So, is there more to go in this pro-China, away from India story? And has the Adani story, made any difference to people approaching India?
Okay, I think Devina can't hear you, so we'll try and just get back to her.
Yeah. I mean, I had a call in. Yeah, please. No, I can hear you. So you were talking about
India in the pecking order and whether Adani story is changing it.
Okay, so I mean, as I've said plenty of times on your channel, I don't think it's a good idea to track FII flows and see where it's going, because that ultimately, if you just plot it from the time FIIs came in, it has really no correlation with the markets. So that remains. I don't think the Adani story ultimately, which is what I said even before the FPO went through, I think the reaction here itself was overdone, and I did not see.
Okay, I think we're having some issue with your audio, so we'll come back to you, Devina. But thanks a lot, gentlemen, for joining us. And of course, we will keep you updated on what happens with the budget, and you will, of course, watch it on our channel as well. Hope to see you again post the budget fine print. But let's move on, and we have plenty of stocks to talk about. So let's get our research team in to give us an update on that. Vivek joins in first on the latest that's happening with the Adani FPO. Vivek, over to you.
Well, that's right. It's a major relief as far as the entire group is concerned, and Adani Enterprises particularly. So the FPO, overall was oversubscribed 1.2 times of the kind of oversubscription that we saw, largely led by the QIB and NII portions that was subscribed 3.32 times. We also understand from our sources that family offices of some large Indian conglomerates were said to have participated as far as the Adani FPO is concerned. Additionally, what we did, we sent out a very long and detailed questionnaire to MSCI, and MSCI responded to us. The key takeaway from this, from the response to us was the fact that MSCI has said that they will inform and announce to all clients simultaneously in case there are any changes to MSCI indices. At this point of time, they continue to take feedback and they continue to watch the situation as it evolves.
All right, thanks a lot for that. Well, Nimesh is also with us. He's tracking Syngene and Biocon this morning. Nimesh, over to you.
Morning, Sonia. So I expect a large block in Syngene today, and Biocon is selling 10% stake in the company via block deal. I expect the deal to happen in the pre-open, and the price band is around 560 rupees. With this stake sale of 10%, Biocon will raise 2,200 crores by selling stake in Syngene. I'll go with green in Syngene because this was much anticipated. It's expected to happen in the block window, and there's a very strong demand from the FIs as well. So, and now there is a 90-day lockup for Biocon to sell further. So Biocon will sell 10%. Go with green for Biocon as well as for Syngene.
Nimesh, thanks very much for that. Sudarshan Sukhani and Mitesh Thakkar are now joining us, as always, to run us through the technical setup of the market. Sudarshan, Mitesh, good to have both of you. Important day. Sudarshan, to you first. Yesterday was the second straight day. We got a positive close once again on the index. Are we in a bit of a recovery mode from here? Your sense?
Yeah, good morning. Yesterday also I said that we should be long in this market, and I repeat that today. Now, there is, of course, that joker in the pack, the budget. If the budget gives something very unusual that, sort of terribly unenthuses the market, that's a different story. I have big doubts on that. But otherwise, the budget can simply be ignored and stay long in this market. We made a significant support level at 17,400. Just look at resistance levels, 17,800, 18,050. These are points where if the market stops, you take small marginal profits. But be on the long side of the market and manage your volatility and volume because of the budget.
Got it. Be on the long side of the market. Mitesh, would you agree with that view that perhaps it's better to be on the long side, and post the budget, maybe the market could stage a comeback? Because even as we speak, the Asian markets, the US market handover was quite strong. What are the levels to watch?
On the index, no. I think I'm not very keen to trade the index right now. Yes, on a lot of stocks, sector-specific wise, I think, we are broadly trading on the long side. But I think 17,800, I think, I still maintain that unless that has been crossed, I'll not be comfortable going long the index. In case there's a disappointment, I think, then maybe index short and stocks long can still be the way forward. So I think it's a slightly not very strongly positively biased picture on the index side, but some stocks are reversing from extremely oversold levels. I think that's where I'll focus upon, particularly fertilizers, chemicals, housing finance, etc., which are also linked to budget in some sense.
Got it. Okay, so let's talk stocks itself with Sudarshan as well. Sudarshan, which stocks today?
Well, primarily looking at buying. So I have an all-buy list. Bharat Forge is a buy. The stock has been in a trading range. It's outperforming the Nifty significantly. Buy with a stop under 864. HAL has been a buy in my list till it started a correction. Now that correction may be getting over. Again, a large sideways trading range movement from which it is a breakout on the upside seems imminent. So buy HAL with a stop under 2470. IDFC First Bank is a buying opportunity, although I'm generally not so upbeat on banks because the Nifty offers better opportunities. But in this case, the dip in IDFC Bank, First Bank, actually was bought into. So you can consider buying it with a stop under 56. And UPL, which had a good day yesterday, already breaking out from a trading range, is a buy, the stop under 748.
And Mitesh, how about you?
Yeah, I have all buy calls today, despite the fact that I'm not extremely positive on the index. But on stock side, I think, as I said, I think a couple of housing finance names look very good. They have started some kind of a short-term up move. So Canfin Home is the first call. Keep the stop at 555 here. Look for an upside target of 590, 595 to begin with. Similarly, LIC Housing Finance is also on the list. That's a buy with a stop below 395 for a target of 415. That apart, HL, again, slightly linked to the budget as the agenda. That's a buy as well. It managed to clear an important pivot yesterday. So that's a buy with a stop below 25.25 for a target of 2600. And Asian Motors is something which is reversing after a good correction. So that's a buy as well. Slightly positional kind of a view. Take a stop below 3200 and 3400, 3420 is the target on the upside.
Okay. Gentlemen, thank you very much. We'll get back to you, Sudarshan and Mitesh. Okay, now what do we have up next? Two very important people joining us, both Nilesh. Nilesh Shah, the MD and CEO of Envision Capital, and Nilesh Shah, the MD of Kotak Mahindra AMC. Back in a jiffy.